1991, I got over to came over to the provider side of the marketplace, and until I left FC Stone in early 2012, I was there for 20 years. I was in the on the provider side of the marketplace, the institutional side of the marketplace. And Ricardo and I see some of our friends are in the audience, and hey guys, great to see you. Thanks for coming over to TradingPub. But we have a lot of new folks here that we're speaking to tonight for the first time, and Ricardo and I have a little secret that we'd like to let you in on tonight, this morning. Actually, it's Friday morning. Hopefully some of you are from overseas, not in U.S. For those of you who are staying up and doing the marathon Trade-A-Thon, congratulations on putting in the hours. But I'll tell you, this is fun. This is a unique concept, and Morgan mentioned earlier that we came upon this by accident when we were noodling about, he had never really done a London version of this type of presentation, and we routinely, we know it from working in the FX markets, and as I was alluding to before, was on the institutional side of the marketplace. My partner Ricardo is a retail trader by trade. He is one of the 97% out there that lose money to the marketplace as a rule. There are foreign exchange on the institutional side. Provides the backdrop upon which we all trade. When you look at your charts, when you look at your MT charts, when you look at TradeStation or Ninja or any of these wonderful chart packages that we have access to nowadays, what you see is the institutional marketplace providing a backdrop upon which we trade. We're secondary or tertiary traders, however you reckon that it fits your sort of mental image of your trading. We're deriving off of we're taking their lead and trying to predict where the market is going next, if you will. I'm going to let Ricardo explain this to you in more detail, but I can tell you that after coming off of the institutional side of the marketplace and being a provider, I was a liquidity provider. I ran a couple of desks. I worked on a prop desk. I worked as a liquidity provider for a Chicago brokerage. Heck, I sold liquidity, institutional liquidity. Liquidity has become the key to success for trading, and it also is a burden in a way because it's an inside baseball kind of a game. The prices that you see projected up there are based on a lot of our thousands and thousands of transactions every day, and they're pumped into the marketplace via these big, beautiful aggregator programs that the big clearing firms have. We have relationships with DirectFX and ILQ for our non-U.S. and U.S. providers respectively. DirectFX is a sponsor and well known to Morgan and friends. They are a terrific up-and-coming clearing firm, believe in client service in a big way, and one of the important things that they do is that they like all of the best clearing firms out there, they're neutral to their clients. They simply provide access to this giant marketplace out there that is 24 hours a day, around the clock, 5.5 or 6 days a week, depending on how you look at 24-hour markets, and they pump their liquidity through these aggregators, and all of this tick data, this wonderful tick data that you see on the screens that will be coming up in our MT4, Ricardo's MT4 charts are provided. They provide a massive volume of trade data. So we do a few things here at Hawkeye MT4. We read volume data in a number of ways. I'm going to let Ricardo touch on that because it's very important. We're in a war on technology. This is something that we've realized, and a light bulb went off when I partnered with Ricardo at the beginning of this year, and he introduced me to Nigel Hawkes' indicators, the Hawkeye trading suite. But there's one thing that Hawkeye has that we discovered is a key, if you will, to unlocking the secret of all of this inside information that these institutional traders share with themselves. And trust me, they do share this amongst themselves. We have finally decoded. We've got a tool, an indicator that can decode this. We're going to demonstrate how it works tonight. We're going to look for live trade setups, things that are setting up while in 90 minutes we may not physically find trades. We're not scalpers as such, but we will be finding trades that are setting up right now. And we'll show you how that's done. And if you are interested, we would encourage you to come over to our website and to visit our room that we run at least twice a week during the New York, and then during New York for 2 hours in New York Open. And normally on Thursday mornings, the day prior to this time, one day prior, we do what we call a free trade session. We'd like you to attend that if this is your daytime. If you're up late, we'd like you to stay up late if you're interested, and watch us try to trade live. And we always archive our trades, and we have them represented, and those are always accessible. And we can get into that a little bit later. But in the meantime, let me read what's on your screen here. The trade like a hawk and rise like a phoenix. It is something that if you've been with us in the past, you know how important this concept is to us. We want you to develop. It's not just a play on the Hawkeye technology. It's our credo. It's kind of our mission statement, and it's something that Ricardo and I came up with. And we want you to develop this hawk-like vision on the marketplace, as corny as that sounds, and rise like a phoenix from the ashes of your trading, which is something that we also feel, because I know from experience that retail traders, it's about a 97%, 3% deal. Let's say on the greatest year, maybe 5% of retail traders make money. We would like you to become one of the 5% because we feel now that we have the ability to do that for you. So as I always do before a show, I want to read our disclaimer. Ricardo and I are both licensed NFA brokers, and we must do this before we do any kind of a presentation. So bear with me while I tell you a few things that you're seeing here. Futures and spot currency trading have large potential rewards, but also large potential risk. You must be aware of these risks and willing to accept them in order to invest in any of our markets, but particularly the Forex markets that we're talking about tonight. Don't trade with money you can't afford to lose. It's always very important. Our website is neither a solicitation nor an offer to buy, sell commodities or FX, and no representation is being made that any account will or is likely to achieve profits or losses similar to those discussed. Past performance is not necessarily indicative of future results. Here's where it gets interesting, and we're required by law to say this. Trading Forex involves substantial risk of loss. It is due to the fact that Forex is such a highly leveraged medium. We want you as traders, if you follow our advice, for example, if you come along with us, so to speak, you'll understand that we want to mitigate risk. It's why we're here. Ricardo and I trade with stop losses at all times. We don't over leverage our accounts. We only expose our nominal equity to a certain percentage of loss. But as you know, you can trade up to 100 to 200 to 1 type of leverage on very, very small fractional margins. And that is a very good thing and a very bad thing if you're caught unawares and if you're careless about your trading. We would rather you learn incrementally and expose yourself to a reasonable risk reward. We talk a lot about risk reward ratios. We are not scalpers as such. We are position traders. We're looking for profitable moves, as Ricardo will explain. We are always looking for a good return on your investment. Now, trading Forex is not appropriate for everyone, but we feel for most of you out there, it probably is. If you're still one of the 388 people with us, God bless you. Only risk capital should be used to trade at all times, and no implication or representation is being made that utilizing our technology will guarantee trading profits or freedom from loss. We would never make that kind of a silly statement. So with that said, I'll be butting in and out from time to time throughout the presentation. And Ricardo, you can hit your screen if you like, or whatever. Go to wherever you would like to go now. I'm going to turn it over to my partner, who introduced me to this technology, and I could not be happier to be with him. This is Ricardo Menjivar. Ricardo, take it away. And by the way, if you hit the Q&A on your screen, if you want to ask a few questions, I will endeavor to answer them as straightforward as I possibly can. And we'll put up some links to track over to our site a little bit later. So, Ricardo, take it away, my man.
Hello, good morning everybody, and good evening to those of you that are joining us that have been here all day. God bless you for it, because I know it is a big sacrifice to be listening to everyone and wanting to learn something new. And hopefully we're going to bring something new to your attention. And we're going to touch upon volume activity and how we're able to now quantify and identify their volume activity in the Forex market. Now, as many of you know, there is what is called a risk of loss when you trade in these markets. Regulators require me to tell you that there is a potential risk of loss. In actuality, there's a huge risk of loss, but we're going to help you minimize that risk. And we're going to explain how. Now, unlike other markets that you trade, Forex is very different and unique. And it's unique in the aspect that there is no centralized exchange. It is created by liquidity providers, institutions, banks, non-banks, and these are the guys that basically move the market. Now, how they move the market and why they move the market is a secret, and it used to be a secret, but we're going to break that down and decode it for you. So hopefully you're going to be able to follow us, and you'll be able to see that what we believe actually can, in many cases, maybe even be helpful to you. One of the things that we feel that we're bringing to you through Hawkeye MT4 is that we're helping traders trade with confidence, and we're bringing a new vision in trading technology. Like Bill said, there is a war of technology out there, and the war of technology that's been declared against the retail trader was declared over 9 years ago. This isn't new. Unfortunately, most of us aren't really aware of the type of war that the banks have declared on us. Like you said, we are trying to basically guess and follow their lead. Well, they've decided to create what we call divisions of algorithmic developers, financial engineers. These financial engineers are known in our industry as quants. Their job is to protect at all time the interest of the banks and to basically develop protocols and algorithms that counter most indicators out there, from RSI, stochastic, MACD, Ichimoku cloud, candlesticks, moving averages, Elliott wave, Fibonacci, you name it. They threw the kitchen sink at you. You didn't even know that they were doing it. And they've allowed an industry of education to be created around this, because in actuality, many educators out there are very good at chart pattern recognition. Well, not every trader is good at chart pattern recognition. And so this is one of the things that unfortunately confuses a lot of people. So we're going to go into that, and we're going to go into that in depth. But right now, I want you to basically just follow me. You know, we're going to be going from one page on the website to another. And we're going to go over the indicators. We're going to go over the leading indicator, which we call the Fat Man indicator. And the reason why it's called the Fat Man is because my friend, Nigel Hawks, who developed it, says that it eats pips. Well, we're going to put it to the test and see if that's true. And hopefully you'll see the same thing that we do. Now, one of the things that you're going to discover with this indicator is that hopefully it will act for you as it acts for us. A Forex radar, an early warning device, and helps clear the trading fog. Now, as confusing as this indicator looks, there is a method to the madness and a madness to the method. Well, there's no madness here. There's just a method. And there's a reasoning behind what you're seeing, and I'm going to show you what it is. Now, each line does not signify a moving average. It signifies the volume activity of each individual currency within a portfolio of 8. And I'm going to explain how that works. But first, I'm going to explain to you what this tool, how this tool will help you, as it has helped us and is helping a lot of traders out there like yourself. You'll discover that this indicator will help minimize trade entry risk. It'll help support, enhance, and improve any trading strategy that you have. Now, if for instance you're very good at chart pattern recognition, this will improve your odds even more. Why? Because it'll lead you to those pairs and those currencies where the bank's interests lie heavily to rebalance. And I'm going to use that term very heavily, rebalance. A lot of people normally would say manipulate, but in actuality, they're really not manipulating because they are rebalancing their portfolio. And we're going to go into that pretty soon. So just hold on. We're almost there. You'll see how this tool helps key traders into extremes of strength and weakness in individual currencies within the portfolio, how it helps eliminate pairs with no clear direction. Why? Because maybe those pairs are in balance within the portfolio of 49 pairs that are derived from these 8 major currencies. It'll help describe in vivid color those standout currencies, and it'll help pinpoint pairs ready to break away. Now, we are not breakout traders. Okay, let's get that straight. And what we mean by breakaway is that you're going to discover what we've discovered, that this tool actually helps identify trade setups 1 to 3 hours before they happen, and in many cases 5 to 7 hours. So, right now during August, because the volume activity has been very low, we've actually had windows of 14 hours before the trades actually unfold, and that's just because the volume activity has been low. Volatility is low, so will the volume. In September, things will pick up, and a lot of these, you'll start to see a lot of these trades unfold a lot faster. Now, one of the things that you're going to discover with this indicator is that it will eliminate what we call analysis paralysis, the old way of analyzing charts, which normally we would open up a dozen or more of your old charts. You would spend hours analyzing each pair, draw the same old lines, hope to find a few good trade candidates, and pick 1 or 2 and hope you've made your best guess as to which currency pair might pay out. We're going to show you that here you only need to open one chart, the Fat Man indicator. It'll help identify extremes of currency strength and weakness. You only open those few chart pairs that the indicator has helped you to identify, and basically you just use one chart to take the guesswork out of hunting for pairs. You zero in on the money flow and momentum, and you eliminate the pairs where there's simply no interest. The strength just isn't there, and the Fat Man helps you spot that. Now, this indicator does approximately 374 calculations per tick per currency pair. That means that it's doing over 18,000 calculations per time frame, whether it be the 5-minute, the 1-minute, the 10-minute, the 15-minute, the 30-minute. It's doing over 18,000 calculations per time frame. So it's taking all that volume activity and plotting it and telling you where they're driving their interest, what currencies they have to rebalance in their portfolio. Not that they want to, they have to. That's a big difference. And that's something that hopefully you'll discover today, which is what we plan on sharing with you. Now, one of the things that we will show you that many people think is, something that cannot be, but hopefully you'll put us to the test and we'll demonstrate to you in actuality what we're saying can be. Market makers and institutional traders cannot hide strength or weakness from the Fat Man indicator. In fact, you're going to discover tonight that their volume activity contributes to the fresh insight traders gain by using this Hawkeye technology, which has been developed. And hopefully, you'll realize that it does help you as a retail trader, because let's face it, as a retail trader, you and I are not on the VIP list of the banks. Truth be told, we are but a grain of sand on the beach, insignificant in their eyes. Many people feel that when the retail market opened up to, Forex for the retail traders, it was to punish the banks. In actuality, no. They basically celebrated because in their eyes, dinner was served, and you and I were on the plate. Well, tonight it's going to be a little different. It's called free money, exactly. Well, tonight it's going to be a little different, and we're going to show you how their volume activity is something that can no longer hide, because every other indicator out there, they've developed a protocol against, except their own volume, because they can't hide that. That's the one thing that they have to report to the dealers, and that's how you and I are able to see candlesticks, bars, et cetera, et cetera. So we do invite you to take a look at, the website, and Bill's going to be dropping links on the chat for you to basically go and, and see for yourself. Now, the first 3 pages are very key because they explain how the technology works and what we're about to explain to you. The 3rd page, which is the Hawkeye tools, actually explains how each individual indicator works. And we're going to go over them today, but it's good to guide you through this, because a lot of you will be able to read step by step what each indicator in this suite does, and how helpful it's going to be, because we're going to be combining them. And so hopefully we're going to be able to take you to that specific level. And the 4th page, finally,
let me just, sorry, Ricardo, I just wanted to jump in and say, we guys, in 90 minutes or 75 minutes, whatever we have to do, we don't have a lot of time to run through all of our indicators and all of our tools, but our website does have a lot of information, and we'd urge you to come on over, have a look at it, and you'll see what we're talking about, and then you might decide to come join us in one of our rooms for a little further training. Sorry about that.
The 4th page is about the developer, Nigel Hawks, a friend of ours, and there's a little video here, a story about him, and a little video where you can put actually the voice behind the face, and a book that he wrote, which is a little informational on the volume secret. And it's his whole thing, his whole school of thought has always been volume spread analysis, but we took it to the next level. When we decided to partner up and come together to do this, we actually realized that we took volume spread analysis to the next level, which is called volume price analysis. And we're going to show you that right now. So now that you've seen this, Bill will be, like I said, Bill will be dropping links in order for you to be able to take a look and sign up, hopefully, to our training room. Our training room, we do 3 sessions normally. We're going to be changing. We're going to be doing 2 sessions in the morning. We're going to be doing 1 session during the London session, which that one will stay the same, which will be Thursday, 2 a.m. to 4 a.m. Eastern. And normally when we do these sessions in the training room during the London session, we don't really talk about the technology. We actually trade real time. And we look for trade setups and real trades. We actually put the technology to work, because we feel it's important for you to see it live. Because one thing is for us to talk about it, explain it. Another thing is for us to actually do it and pull the trigger. You will see us pull the trigger live. During the Monday, Wednesday, and Friday, that is from 9 a.m. to 11 a.m. Eastern Time. We're going to be changing that mid-September, the dates. More than likely, we're going to be doing Tuesday and Friday, 9 a.m. to 11 a.m. Eastern Time. So watch out for that change. So before anything, let's go to the charts. Now I'm going to explain to you how their volume activity gives them away. And let's go to what we call our leading indicator, which is the Fatman indicator. Now I'm going to explain to you how this thing works. And it's very unique. Like I said, as confusing as it looks, there's a science to it, and hopefully you'll pick this up. Now each line here represents the volume activity of each individual currency within the portfolio of 8, which in actuality is a portfolio of 49 pairs. Why? Because we are taking the Australian, which is the red line, the sterling, the orange, the Japanese yen, the purple, US dollar is the aqua, the CAD, Canadian, is the yellow, euro is the lime green, and the Swiss franc is the white, and last but not least, the New Zealand, which is the dark blue line. Now, what I'm going to explain now is how their volume activity is basically exposed. Remember, we're looking at 8 currencies and how they trade against each other. Well, how they trade against each other is also going to key you in on what pairs you need to concentrate on, because that is where the bank's interests lie. And every day, practically, in many cases, there is always a different currency pair that they must rebalance. And I'm going to explain to you what rebalancing means and why they do it. For instance, we look for extreme levels of strength and extreme levels of weakness. Why? Because that means that once they've weakened a specific currency, in this case, the sterling, which has been brought to levels of weakness that it can no longer sustain, must be brought back into balance with portfolio of 8. So that means that there must be also another currency that has been taken to a level of strength which can no longer be sustained and must be weakened and brought back into balance within the portfolio. And that's what they do. And that's what this algorithm keys you in on. Now, what it's doing is that it's extracting individual currency strength and weakness from each pair, which in this case there are 49 pairs, and telling you how the New Zealand is trading against its counterparts, against the Swiss franc, against the Aussie, against the euro, against the British pound, against the Canadian dollar, against the US dollar, and against the Japanese yen. And it's doing the same thing with the other currencies. It's telling you how the yen is trading against the dollar, the Canadian, the sterling, the euro, the Swiss franc, the Aussie, and the New Zealand. So what we look for with this indicator, because this is basically where they key their volume activity and interest in, this is where their interest lies. Their interest lies in rebalancing their portfolio. Well, in the 1 hour, this indicator is telling us that the sterling had been weakened to levels it could no longer sustain and must be brought back into balance within the portfolio. Well, the same thing we're seeing with the Australian. The Australian had been taken to levels of strength it could no longer sustain and had to be weakened, as well as the CAD. And so if you ask me what two currency pairs they're concentrating on rebalancing the most and where their volume activity lies, well, I just told you. The sterling Aussie and the sterling CAD. In a matter of 3 minutes, I could tell you that these were the pairs where their volume activity was so high that they had no choice but to rebalance. So that means that out of the 49 pairs, they concentrated on rebalancing the Australian against the sterling and the Canadian against the sterling. Now, do we have the potential of seeing the New Zealand and the sterling rebalancing? Yes. Not yet, but it's coming. So what we do is that we look at for intraday trading, we look at the 1 hour, and normally when the volume activity has come back to normal and the volatility is back in the market, you're going to see that the 1 hour is going to be really a very key component in your analysis, because anytime that you see a currency pair cross right in the middle or close to it, this is a 4-hour trade that normally would generate between 150 to 200 pips in your favor. Well, if you know where their interest lies, then the next step is going to the chart. And I'm going to take you there right now. We're going to take a look at the pound CAD. And we're going to take a look at the pound Aussie as well. First things first, the pound Aussie. Now, these indicators that we see here are unique because this suite actually does 320 calculations per bar. And what it does, it takes into account the open, high, low, and close and weighs it against previous candles to try and extract volume, their intent. The green dots and the red dots are trend dots. The yellow dots are isolated highs, isolated lows, pivots. The white dots are congestion dots, and these are important too. These stars that you see here in this line, these are your trend stops. This is your hard stop. This is your soft stop. As for diamonds, these are wide bars. That means that there was a lot of liquidity injected at that particular time frame. And so that's what it's going to reflect. The heat map runs in 3 intervals. If it is all green, bright green, it's slow, fast, aggressive in the same direction. If it's dark green, it's slow, fast. If it's dark red, slow, fast, aggressive, bearish. And we look at the heat map because it does help, maintain a consistency of where their volume activity still lies. Now, we're seeing here that their interest is in driving the sterling long and the Aussie short. Well, they've already started in that direction. Normally what we do here is that we'll go to the higher time frame and we'll actually see exactly if that is the case. Well, you can see right here at this point, which was towards the end of the trading day earlier yesterday, that they had already intended in rebalancing the Australian and the sterling. You could see that they started doing it during the European session, but they really followed through during the US session. Now, as soon as they crossed here, as soon as you saw a cross right here, that told you right then and there that this pair was no longer going to go short, that their volume activity was driving the sterling long against a portfolio of 8, and that they were driving the Australian short against a portfolio of 8. As they crossed in the middle, or very close to the middle, you could see that they flatlined basically here, flatlined, but at the end it was going to rebalance. And you can see what happened here. You had hours of resting period and congestion where nothing happened. But at the end of the day, the real intent was to drive this trade up. Why? Because previously, and we can see here what has been happening, and I'll do that in a second. Let me make this smaller. You're going to see that this pair had been going up 1, 2, 3 days, and they hit a fourth, peaked. Well, when they have too many traders following them and riding their coattails, what they'll do is that they'll run the stops. They'll stop people out and then continue. Well, that's exactly what they did here. They went long. They saw that too many people joined the bandwagon. They said, wait a minute, too many people are making money off our coattails. Maybe it's time for us to rebalance. So they did. So they brought it short, and then here is where it gave them away, that they were planning on going back long. And that's exactly what they did. Many people don't realize and understand that the banks know, because they can see our volume. They can see our pending orders, our limits, our stops. They can see everything that we have, but we can't see theirs. I call that unfair. Well, now we're leveling the playing field, because you're going to discover that with this technology, you can actually define their intent hours in advance before it happens. Now, this happened literally, let's see what time this happened at. This was 2030, so this was 1, this was 2 o'clock, so 1:30.
Now you're talking about when the fat man crossed, when the sterling crossed over.
Right, this was about 4 hours before the close of the day. And then it went flat. Now you can see why it's so valuable to see in the higher time frames. Now their volume activity, bearish, was diminishing, and you can see the bullish volume starting to creep up. And here basically they made a stand, but it didn't make sense because this was bullish, but the volume activity was bearish. Started to increase, but you can see that they never really retested the lows, and then the bullish volume started to basically creep up. Now we knew that this was going to rebalance, and it was just a matter of time before it popped. So normally what we do is that we developed a method called the Phoenix trading method. And the reason why we call it the Phoenix is because we feel very strongly that it's actually helping traders take their trading and rising from the ashes from it. Because now you're on the VIP list that they don't want you to be on. Normally what we do is that we box in the pivots. And by boxing in the pivots, what we're discovering is that we're discovering where their interest lies and when they're going to actually rebalance. Now in this case, that's a 56 pip range within this area alone. That's too wide. Normally we look for 10 to 20 pips, maximum 25 pips. Anything above that, it's a little too dangerous, it's a little too wide, and simply would not take it. So what we do is that we start to box in pivots within that range to identify and see what their volume activity is doing. What is their next game plan? This one's 18 pips. This one's a little bit more acceptable. But this was the first range, but the next range that we're going to be looking is this one right here. And the reason why we do it is because when you see that these pivots compress against the candles and the trend dots within a range, that tells you right there alone that they are planning on actually breaking out in a different direction. That's why we are not breakout traders. We are breakaway traders, but we break away where their volume activity is actually leading us. And in this case, we knew they were no longer going short. The Fat Man indicator basically said so and told you, as a risk management tool, do not go short, because if you do, you're gonna get hurt, because their interest is no longer in taking this pair short. Their interest has changed, and their real intent is to go long. Well, look at it from this perspective. If you play poker, what makes a good poker player? A good poker player can tell whether his opponent is bluffing or not by reading his tells, his facial expressions. And good poker players don't like to show their facial expressions. You'll see some guys wearing hats, sunglasses, have a stiff face, but they never move. I mean, they're like paralyzed without an emotion, you know? Even though on the inside they may have a bad hand and they're calling a bluff, but if you can't read it, you'll lose because you won't know whether they're bluffing. Well, now, the banks can bluff all they want, because in reality, guess what? I know that their intention here is not to drive this currency pair short anymore, but it's to drive it long. And the 30-minute gave them away. I'll tell you why. Because each white dot here signifies that their volume activity was undecided, indecisive. They weren't short, they weren't long, they were flat. Now, on top of that, that's their tell. Exactly, that's their tell. If you're a good chess player, then basically, you know, my father taught me how to play chess when I was 10 years old. And he told me that some of the best chess players out there can read their opponents 10 steps ahead. Now, if your opponent can read you 10 steps ahead of what you're doing, he says you've lost, because now you're playing his game. Well, now, we're not playing their game, they're playing ours, because now we can tell when their volume activity is giving them away, because they can't hide it. That's the one thing that they can't hide, is their volume activity. They can throw everything out there. They can, you know, play with the candlesticks, moving averages and what have you. But the one thing that they can't hide is their volume activity. And this indicator right here, the Fat Man indicator, which basically here we're just isolating the two currencies that we're interested in. Remember, we saw interest here. Right here is where we saw in the 1 hour.
Yeah, that's the same. That's
the same chart.
That's the same chart underneath the currency. It's just all it does is we have a little trick that we do that isolates the two that you want to pay attention to, and that's the orange and the red one in there.
Exactly. So what this thing is doing here is that it's actually keying in on their volume activity per time frame. Now we can see it in the 1 hour. As you can see, it's just crossing. And you can see the transition in the heat map is now dark green. So it went from bright red to dark green. Basically, stop. I'm not going bearish.
Hey, Ricardo, while you're doing that, take a minute to explain to our new friends a little bit about the heat map and a little bit about how the Hawkeye volume bars are a little bit different than your standard MT4.
Oh yeah, they're different in the aspect that because they key in on this whole suite does 320 calculations per time frame, okay? So basically, we're doing a combination. We're combining the Fat Man, which does 374 calculations, along with this one that does 320 calculations. So what this does is that per time frame, it quantifies the volume activity, their intent, where it's going. So it'll take into account, like I said, the open, high, low, and close. It'll weigh it against previous candles. It'll recalculate, and it'll tell you whether this bar is really bullish or bearish. So in this case, for the past few hours, you could tell that their volume activity has really been bullish. Even though they've been trying green bullish, exactly.
Red bearish.
Even though they've been saying, hey, wait a minute, no, I want to go short, and they've pushed candles short, but no, nothing. Nothing. You know, it's like basically, all right, I'm going to go short. Come on, come jump in. They're trying to induce you. They're trying to make you fall into the trap. This indicator down here is telling you, do not fall into that trap, because that's what they want. They want easy prey. And now, they're the easy prey, because now you can see with this indicator and this technology, with a clear vision, okay, a clear vision, that their real intent was never to go short. It was to shake off anyone that had been going long for the past 3 days, in this case 4 days, stop them out, and now attempt to go long one more time. So as we go down to the smaller time frames, just in this currency pair alone, you can see how their volume activity is now increasing. You can see it here, you can see it here, the trend dots, and basically they're ready to break out. Normally, this trade, you could say from this point to this point, it has the potential to go up right back here, which is 144 pips. Now, you can monitor this, you know, for the rest of the morning or you know, before the Friday close, and you'll see that they're going to drive this thing up. Their next level is here, which is about, I'd like to say, about 60 pips, 70 pips, 64 pips. And from this level, they may break up here to about 113, but realistically, they'll go up 133 pips. So, but they're going to do it nice and slow. Now, remember, normally you would never trade the pound sterling. Why? Because it's not one of the major pairs that everyone recommends.
You mean the pound Aussie?
Yes, pound Aussie. Yeah, the pound Aussie, forgive me. So in most cases, many people tell you trade the pound dollar, euro dollar, US Swiss, US yen, US CAD, pound yen, euro yen, Aussie dollar, New Zealand dollar. Those are the ones that everyone really likes to concentrate because that's where all the volume lies. Now, I'm not going to tell you that this is one of the most liquid pairs that we're looking at. It's not. But in many cases, they'll rebalance the British pound against another exotic pair, another currency, creating an exotic pair within the portfolio of 8. And the reason why they do that is because they may not be interested in letting you see what their real intention is with the dollar or the euro or the Swiss for that matter. Now here, for instance, we're seeing that, you know, the sterling is bullish, but so is the yen. And you can see that right now, what pair that normally you would not even look at, CAD yen is in play. Yen going long, CAD going short. And we'll take a look at that one right now. And where can you be? Let us pull you out from hiding. Now this is one of those very few pairs that normally no one really likes to look at. Why? Because it's just not there. Now, based on how this is currently trading, I would never touch this with a 10-foot pole. And I'll explain why. Because it hasn't really flatlined, it hasn't had a nice resting period, and it's just been trading very aggressively. So even though the indicator is telling me, the fat man's telling me, hey, this one looks pretty good, well, the chart is telling me, no, it doesn't. You may want to stay away. Why? Because the range in this case, from the pivots from high to low, we can do it from here to here, from the open to the high, was 28 pips, 30 pips. What do we say about anything above 25 pips?
And those yellow dots are isolated high and low pivots, and that gives you a real nice kind of visual on how these individual time frame candles have been trading. And when you're seeing a lot of isolated highs and lows like that, it's jobbing all over the place. It's kind of order driven. You can tell it's a thin market. A little bit of volume will come in, pound the market, pound it up, set a high candle, set a low bar. Just the opposite, might just happen the next one or two candles down, and that's not the kind of formation that we're looking for to set up.
No, we're looking more for this. This is what we look for. We look for them to give us basically volume activity that says, I don't know what I want to do yet. I don't know if I want to continue to go short, and I don't know if I want to continue to go long. Well, if the fat man's telling me that they're going to go long, and this is telling me they don't know what they want to do, well, then I'm going to wait for them to tell me and show me with their volume, in actuality, what they really want to do. And what they really wanted to do was that they wanted to go long. Now, they broke out of this range, so it's obvious that this one will continue to break out to the upside. But the volume here is telling you now, well, wait a minute, maybe just not yet. I'm just not sure yet. But this one, you see how it has that nice angle and separation? Unlike many moving averages where you're looking for a moving average cross, nice angle and separation, this thing will show it to you way ahead in advance. And so, you could have seen this on the 30-minute, literally right here. So that means that before this thing actually popped, you had over, I'd like to say, 8 hours before this thing actually started to, to mobilize and unfold. So let me repeat that. You had 8-hour notice before it actually decided to go long? Is that possible? That their volume activity is that outspoken that they cannot, confuse or hide, against this algorithm? That is exactly what
you can't counter program your own volume. When you are trading, when the institutions are trading, this represents all of that trading graphically. That's what these charts are. That's what transparency is. This massive amount of tick data that's going into these MT4 compilers, data compilers, if you will. It's the whole marketplace of the large, the major 13, 15 bank and non-bank contributors that really make up the ultimate end users of and therefore the providers of this liquidity. So you get to see it all in front of you, and it's real world. When Ricardo talks about tells and the giveaway that the market is giving here, it's based on real factual, real world information. When a market is getting oversold, it will need to rebalance higher, and that's because it's a zero-sum game. There is only X amount of currency being traded out there, and it's going back and forth, back and forth, back and forth, back and forth, thousands of times an hour at all these different institutions. And if a market is oversold, that means that it's out of whack, it's out of balance, and it needs to come back out. So we're looking for a fat man down in that maybe that 20% sort of level. That's what it translates to. This is not a traditional strength meter or an RSI or an ADX. This is very different, as Ricardo was talking about earlier, in that it breaks out all of these 40-odd pairs that make up that are utilized to compile these 8 majors and all their data. So it's a very, very interesting and a very real tool, and we have come to realize that it's the little sort of magic 8 ball that tells you where these guys are going, because they can't hide it. They can't hide when when the market's loaded up, it's loaded up one way or another. So we look for these pairs that are behaving a certain way based on the fat man, and then we go to the charts and translate and see if that means, hey, this is a trade. This is definitely a trade we want to look at, and then we further define it. So
Thank
take
you.
it away, my man.
Well, in this case, you were notified a day ago that the sterling was going to rebalance to the upside and that the Swiss was going to come crashing. Well, if that is the case, I would have never traded this because I was looking at this. But I was more interested in the fact that the sterling was still interested in going long and that eventually the Swiss was going to crash. And you can see their volume activity here was basically diminishing. Their bearish volume was diminishing drastically, and then suddenly their bullish volume started to creep up. Now, what I like about this transition in the heat map is that it goes from bright red to dark green to bright green. Where would my entry be? It would have actually been...
Explain that color transition.
Well, basically what they're doing here is that basically they're telling you that, as you can see, the volume activity has been diminishing on the bearish side, okay? Now, it hasn't been increasing a lot on the bullish, but you know right here that their interest is no longer to go short on this pair. Their interest is to rebalance it to go long within the 49 pairs. So as soon as this transition takes place, it's telling you that they're no longer heavily bearish on this. They're starting to diminish their volume activity, and you can see that the bulls started to creep up. So that's why the heat map went from 3 speeds down to 2, down to 1, which is actually 2 on the bullish, and then finally 3 on the bullish side. Now, their volume activity isn't the greatest. However, their intent is to go long, and that's exactly what they're going to do. Now, where would I have gotten in? I would have gotten in on the 15-minute, literally right here. Why? Because of the transition. Like I said, first things first. We take the information that they're giving us, and we're using it against them. In this case, we're boxing in the range of pivots that is basically telling you and telling me that they have no interest going short. That's a 14 pip range and very acceptable within this method. Since we knew that the Swiss franc was going to basically diminish its strength against the sterling and that the sterling was going to increase its strength against the Swiss, basically we're waiting for that information. So remember, the indicator is telling you that this is going to play out. You may not want to listen to it, but it's screaming at you, don't go short, you're going to get hurt. As a risk management tool, it's telling you where their interest lies. Their volume activity is no longer bearish, it's bullish. So you could have gotten in right here, and you can see the transition. As soon as you saw the trend dots going, these white trend dots going long, and you saw that this basically went green on all sides, and you saw nice angle and separation, your entry could have been in any of these candles. That means that you could have gotten into that trade earlier today, and you would be up right now, 18 pips. So you would have paid the spread, you'd be up about 15 pips. But more importantly is that you know that their real intent is to drive this thing long. So what is the next level that they're going to drive this to? I'll tell you right now. Based on the previous pivots, they're going to hit this one, 45 pips, and they may come to the previous high, which is 56 pips. Now, if you know that that's where they're moving, then would you still continue to go short? The answer is no. You wouldn't continue to go short. You'd be looking to transition into this trade and go long. And that is where the secret lies, in their volume activity. When you put everything together, If you're great at chart pattern recognition, like I said, this will improve your odds even more. Because now, what this indicator is doing is that this indicator is actually telling you, hey, you need to be looking at the Swiss franc and you need to be looking at the sterling. Why? Because the sterling has been rebalancing and strengthening for a day now. And the Swiss franc has been doing the same. Now they crossed here, but they went back up and said, nope, not yet, and then they finally crossed here. Now normally, like I said, I like to see a cross right in the middle. That's why I like the pound CAD, because the pound CAD was a little bit more clear, but the pound Swissy was cleaner. And look, it's still bullish. It's pumping away right now as we speak. Slowly but surely. Now take into consideration that under normal conditions, you know, what I call normal is really not normal. But when the volatility is high, and the volume activity has come back because the senior traders are back, this trade would have ripped 150 to 200 pips in many cases. And right now, you'd have a smile on your face the way I have had for the past few months. Because we have been able to identify trade setups 2 to 4 hours in advance before they happen, and literally see these things explode before our very eyes. You know, 50 to 100 pips in less than a few hours. And then at that point, we're in the green that we're no longer concerned about them hitting our stop, because our stop is literally 20 pips to 30 pips below this level. So if you would have gotten in here, your stop loss literally could have been 30 pips, another 10 pips below this level. But it was never going to hit it, because their intent was always to drive this thing long. They were going to take out people that were going long in this pair and basically stop them out, because their real intent is really to take this all the way back up here. That means that this trade has the potential to going from this level all the way back to this level, which is 90 pips from where it's currently at. Now, in many cases, these trades right now are taking about, 2 days to actually play out, to move 200 pips.
That's the summer market for you. I'm sure if you've been here all day, you've talked about how thin these markets are this time of year. It's just the reality of the spot Forex markets. The August is the European holiday month. The end of July is kind of the beginning of the U.S. holiday. The various 2-week periods that guys take off. So we're in extreme illiquidity right now, and that means that the rebalancing trends tend to take a lot longer. The entry risk tends to be a lot higher. Like when Ricardo boxes in this Phoenix technique of boxing in these isolated high and low pivots is very nice for giving you a vertical risk picture of the entry and exits and the ranges that are being that these currencies are gearing toward. Remember that these charts are, the dealers all look at the same price charts. They all see exactly the same data. So they whether they're doing it subconsciously or not, they're gauging their entry based on the same data that you're seeing. So you have to be mindful of it. Where they're driving orders into this marketplace, we're reacting to what they're doing. So it's important to get this look at what they've done in the past in order to predict what they're likely to do in the future. And now from the audience, our friend is asking why you're looking at sterling Swiss right now and saying it's cleaner. What was less clean about the sterling CAD?
Oh, wait a minute. No, that was a sterling Aussie.
You weren't able to.
Yeah, the sterling CAD.
That was
this
sterling
was sterling Aussie. Yeah, this one, as you can see, it was very aggressive. You can see basically, the range was 50 pips. Then it was 18 pips. Then finally it leveled off, and then this one was about 15 pips here. You can see there was a lot of chop in between. Where this one the pound Swissy, or the sterling Swissy, was very clean. There wasn't aggressive chop. It was nice, transitional. Now, take into consideration that these pairs are not the most liquid pairs. So whenever you see these pairs mobilize, they begin to mobilize because the banks are using them, how can I say this in a way that, they're using these as a stealth mode of their rebalancing, okay? So for instance, if we look at the pound dollar, we'll pull that one up. The pound dollar is right here. You're going to see that this one was not really clean, you know. It's, and I'll put the Fat Man indicator on for you to see how this one has been trading. And the reason I want to do that is to show you how this thing has been reacting. Because if they're not rebalancing it correctly, I'm not interested. Even though it looks great, I may not be interested. Simple reason is that at any moment they can change and give me a beating. Well, this one here showed you that they were going to rebalance it properly. And I didn't look at this one earlier. And you can see the transition here was clean. It wasn't aggressive, you know. It was fairly clean. If we box in the pivots on this one, from here to here, you're seeing a range of, oh, back here, I'll go away, 22 pips, still acceptable. But more importantly, is that you're seeing another range as well. And this is where this method becomes really just really important, because it really takes you to a whole other level of understanding. That right before they decided, uh-oh, my mistake right there. Okay, so right before they decided to take this thing long, whoa, that is 4 pips, 5 pips. Well, as you can see on the 15-minute, it's been going in the same direction. I don't like that. That annoys me. I like it like this. When I see this clean, I need to see this on the 15-minute, and I need to see more of it in the 30-minute, and I definitely really need to see it in the 1 hour. Well, here in the 1 hour, you know, basically said, hey, wait a minute, we're not going short anymore. We're thinking of going long. And that's exactly what leads me to start looking at the smaller time frames in the charts. So now, yes, this one is already going long, and you could have actually taken this long, and that probably, if the volume activity is sustained and they rebalance it properly, this one will probably come all the way back up, and you're looking at 100 pips to the upside. However, the ones that were better were definitely the Australian against the sterling, and definitely this one, the pound Swissy. This one was the cleanest of all of them. So this indicator, basically, you're looking for extreme levels of strength, extreme levels of weakness. But you're looking at these levels here. This is where it matters. However, this one here, the Swiss franc, had come to this level, come down, went right back up, retested. Once it came back up to retest, then at that point it was a giveaway, and we all knew that it was just going to come down. And so then it basically was one of those pairs that you needed to pay attention to, because it had already told you a story the previous day of how it was going to unfold. You just needed to isolate it here to make it look cleaner. And you can
now for the larger rebalancing, if you will, for the currencies that are really over long or over short, overbought, oversold, whatever, you'll look at the longer time frame, Fat Man, and look at the curvature
Right.
of those
Yes.
trends, won't you?
Yes.
You'll look at the hour. Or
Yeah, I'll
you'll
look
even
at the
go
hour.
higher, and that will give us a bigger,
Exactly.
cleaner picture.
Because each time frame, as we've said, basically isolates individual currency strength and weakness against the other currencies, and basically tells you, hey, you need to be paying attention to this. Well, the next one that I'm interested in looking at, which has been a stubborn mule, has been the New Zealand dollar. Why? Because
it has
been strange. It really has. And it's getting ready to trade against the pound. Now, rarely have you traded this pair. But look how beautiful this looks. I mean, I'm in love. Literally a whole day of congestion, and then suddenly they decide to go and just, go. They're really, I mean, this is like a marriage made in heaven. I live for these trades. These are the type of trades that I like to identify because they're painting a picture. I'm very particular about buying art. I'm not a fan of it, okay? So it has to paint the right picture for me in order for me to buy it. I've yet to understand. Yes, exactly. Now, in this case, it's a 112 pip range. That's a pretty wide range. However, for a 112 pip range, they literally have been undecided within this range of what they're going to do. And that is a little bit concerning. Now, how would you box this in? Like I said, it has to be clean. If it's not clean, it doesn't make sense. In this case, we would probably box it in from here to here. To see as the range compresses against the candlesticks and the pivots. 42 pips, but then there was another range. And so this is the one thing that we show you, how to pinpoint these pivots, how to identify them. And as you learn to identify these ranges, you'll start to identify opportunity. And this is about 10 pips. So we went from 14, was this 14? Or how much was this again? Well, you can see 40? Yeah, 40. So we went from 40 to 9. But you can see how basically you had hours of undecided volume activity. Now, their bearish volume diminished, and you saw the bulls come in slowly, 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 camouflaging their move, because that's what they were doing. Their real intent was always to go along. That's why you go to the higher time frames to really see if that's exactly what they're going to be doing. Well, this one basically gave it away. Now, this is the 30-minute. Now, on the 1 hour, they're barely about to cross. Barely. But look how many days this thing has been going long. 1, 2, 3, 4. And now you're going to get number 5. But they basically went flat to get everyone out. But their real intent is to continue the move. So that means that their bluff is not working with us, because this nice angle and separation that you see right here is telling you that they're going to literally slaughter the volume in the New Zealand and basically bring in the sterling for the kill. And they're going to drive this thing up. Now, remember, when they rebalance a specific currency against another, it's not what they want to do. It's what they must do. It's a have to. They have to do it. Because if they don't, they will throw themselves under the bus. Why? Because they can't sustain these levels any further. In this case, on the 1 hour, it's telling you that the sterling is on the move to the upside, and that the New Zealand, if you notice here, it came up, came down, came back up. A second time around, anytime I see a second time around, I know that that currency is going to crash and burn. And so that's exactly what it's doing against the sterling. And it will also do it against the yen. Now, you and I both know that the New Zealand yen is the last yen pair on your mind, because that is the one that no one talks about. That is the one that is like in the back. You know, they're like, really, the New Zealand yen? Are you kidding me? You would actually trade the New Zealand. Well, it's telling you that their volume activity is telling you they're going to rebalance the New Zealand against the yen. Now, they haven't crossed here in the 1 hour, but let me show you the 30-minute. Whoops. Right smack in the middle. Angle and separation. Normally what I like to do here is that I like to use a different shape, a triangle. And I'll show you why. Because it allows for you to see basically where their intent lies. Their intent is to rebalance that pair. And look at it right here. I mean, they're pushing it hard on the 15-minute. So we'll take a look at that. We'll leave this one on because this one's really nice and it's still going long. As for the pound New Zealand, you know, it still has room to go, but we'll leave it be. We'll migrate to the New Zealand yen.
While you're changing that, I'll throw in. The pound New Zealand is. There's been a lot of buying interest in the sterling, and think of their need to rebalance as inventory stocking a store, for example, because you can only get so long sterling US, for example, or euro, or you can only sell so much euro sterling. There are only so many ways to buy the pound. But if they see a weakening in one of the sides like the New Zealand, this might give them a new opportunity to take in sterling. If they need to buy sterling and they just can't get overly long one particular bit, then they'll go to these alternate pairs and they'll reload their inventory that way, and they'll offset their risk somewhere else, which is the interplay between all of these individual currency sides and why these so-called outlying pairs get a lot of volume bursts, because this is a way for the institutions to sort of rebalance their liquidity needs without overloading their books one way or another. You can have a full portfolio of sterling as long as it's relatively in balance, or if you've been talking to options people, delta neutral, for example, they're risk averse in terms of their exposure, their overall exposure to one particular currency pair or another. So that's why you get a lot of interesting corresponding movements in these outlying pairs, and why sometimes you get a nice lead time, and the fat man turns you on to that. So that's kind of the inside baseball look at why some of these currency pairs rebalance the way they do. But you still get the visual on the fat man, no question about it. So where are we looking at now?
Yeah, we're in the New Zealand yen right now, and we're basically seeing how it basically, started to rebalance. Now, I wanted to go here because I wanted to see, okay, basically went short, went long, it's going short again, and so that means that if we go to the higher time frame here on the 30-minute, oh, it was going short 1, 2, 3, 4 days. Too many people jumped on this one, or a lot of small banks jumped on the bandwagon of the big banks, and the big banks said, oh, no, you did not. No, no, no. No, senor. We're going to stop that, and we're going to stop you cold right here, right now. Well, you wouldn't have known that they were going to take this long and stop you out unless you were using this indicator. Why? Because this indicator told you that they were going to stop going short. And so they strengthened New Zealand, weakened the yen. They went long to stop everyone out, but now they're going to go back in that same direction, and they want to go short. They're itching to go short, and you can see their volume activity is starting to creep up, bearish. The yen is starting to slowly get stronger against the New Zealand. New Zealand is weakening, and that's why you're seeing this pair going to make one more attempt to come down and retest this level. Now, if it fails to break this level, then they will transition to go along, and this indicator will show you that. If it achieves it and breaks this level, then this thing's just going to go right down the floor. And as soon as it goes down the floor, that means that it's going to come down pretty heavy. Now look at it on the 1 hour. Isn't that a beautiful coming together? I mean, you know, they're both angled in the same direction, ready to just kiss each other. And normally when I see a trade like that, I call that the kiss of death, because that's like me blowing a kiss to the bank saying, you're mine. Your bluff didn't work, and now it's my turn to show you my ace in the hole. And they're like, but how, Ricardo? Why? Because you can't hide your volume activity from me any further. You're done. And that's exactly what we're looking at right now. That's exactly what we're explaining to you, that they can no longer hide their volume activity. Now remember, they have the money. If they choose to, they can just basically take this long and take us out. So there's always a risk. However, because we're keying in on their volume activity and they have to rebalance this pair, the probability of them not following through is very low. In many cases, the probability of them following through is very high. And so this is one trade that normally, like I said, one pair, the New Zealand yen, when I talk to people and I say, yeah, you know, I took a trade in the New Zealand yen, they said, you traded what? Like that. I go, yeah, the New Zealand, but why? Because they were going to rebalance. What do you mean rebalance? Yeah, well, the banks have a portfolio of currencies, 8 major currencies, and they rebalance them every day. And every day, all the time.
All the time.
Money, you
Money
know,
never sleeps.
I love that movie Wall Street just for that, because they're really right. Money never sleeps. Money must be in continuous motion. Now, in no form or fashion have I gone to a pair and said, if you've noticed, and said, we'll go to the 15-minute on this, and said, wow, look at those candles. Look at that M formation, or look at that head and shoulders. No, because I'm horrible at pattern recognition. I've never been good at it, and that's why when I started trading 9 years ago, and I bought Forex Made Easy, I was excited. I was like, yes! I spent $3,000 on 2 moving averages. Man, I'm going to make money. And I lost $25,000 of my own money, and my wife almost killed me. You know, however, we've all been through that. We pay our dues. And then I started to look at technical analysis, went to Steve Niesel, learned how to read candlesticks, and I said, I found it, the Holy Grail. That didn't work. Okay, then we incorporated candlesticks with moving averages. We started incorporating MACD, RSI, stochastic, and oh my God, it just went on and on and on. Well, finally, I realized that as a retail trader, I must be doing something wrong. And since I have a background in economics and politics, because that's what I studied in college, I said, there's no way that this market is going to make me feel ignorant when I studied it. And yet I feel like a fool. So then I decided to become a broker about 5 years ago. For one reason only, to discover what I was doing wrong. Well, I became very good, and I developed a very big book. I actually had about 1,000 clients under my book, both retail, emerging CTAs, and some institutional. And I discovered what the banks were doing. And I said, you know, how? Because I was designing different feeds for different types of traders, different bank feeds, providing different liquidity for each different style of trading. Now, if it was an emerging CTA and he was basically going in with 50 to 100 standard lots a clip, I needed to design a specific liquidity feed that would fit his trading style. And that's when I discovered a little bit of how they operated, but I couldn't really put it all together until I met Nigel about 6 years ago. And he came to a Forex LA user group that I belonged to, and he gave his spiel about volume spread analysis and this and that, but he hadn't developed the Fat Man Indicator. Fat Man Indicator has only been out for about a year. And so finally he got my attention. He said, take a look at this. You're going to like it. And I said, all right, let's take a look at it. I got nothing better to do. And then I said, wow, this fool did it. He actually figured out something that none of us have been able to pinpoint. He took an algorithm that calculates and extracts individual currency strength and weakness from 49 pairs and tells you exactly what they're really doing against the other 8, against the other 7 pairs. And so it took me 4 months to develop the strategy behind this, where finally I felt comfortable sharing it. And now, that's what you have here. You have a strategy and a method that actually shows you and takes you to identify and pinpoint the currency pairs that they are interested in rebalancing, not by choice, but because they have no choice in the matter anymore. Because they have basically, if you really think about it, they've sold too much yen, and so now they have to buy it back against the other currencies. They've bought too much New Zealand and sold too much of the other currencies against it, and now they have to sell it against the other currencies again. And so they're constantly coming back and forth, back and forth, back and forth, and every day or every 2 days it's a new currency pair. Back and forth, back and forth. Well, I finally realized that they were going back and forth, that I said, wow, this makes sense. They're rebalancing their portfolio. When I discovered, because many people, many think that they manipulate, the market. No, they're not manipulating. They are rebalancing their portfolio. This is what we as retail traders had yet to understand and accept. So at this point, now you can actually see, oh wow, okay, this makes sense. This is something that I can understand. This is something that I can explain. This is something that I can share. And that's what we're doing here. So we do invite you to sign up for our training sessions, because we're here to take your level of education to the next level, to bring the final piece of the puzzle where now it can all make sense. Like I said, if you've gone the path that I've gone, this will make sense. This will make sense, and it will, number one, guide you to the pairs where they're actually going to drive and manipulate, if you want to call manipulate. I really call it rebalancing. And they're going to tell you when you should not trade and when you should trade. Or they're going to tell you when you need to stay away from a pair. Like for instance, if we look at the 30-minute, I'll tell you which one I wouldn't touch with a 10-foot pole. And the one that just doesn't, really call me out, just doesn't say, Ricardo, is the US CAD. And we'll take a look at that one real quickly. Why? Because it's flat. It's not doing anything. And if it doesn't call you out, then you got no business getting in it. See the way they've been trading this? Yes, they went flat. They decided to basically kill the CAD. But now look, now it's the CAD getting stronger, the US getting weaker. What does that mean? This will go short. But they've been trading in the same direction, flatlining, for a long time. Even though it's been going long, at any moment, any point, they can change directions. And they've done that too many times. And so unless I see it coming from a level of extreme both ways, I'm not interested. They couldn't pay me to look at this trade. And look at how it's been going. But look at how they've been rebalancing this in such a, how can I say, odd manner that it just hasn't really made sense. And so I would rather go look at a trade that makes more sense, at something that's more cleaner, and that one just wasn't cleaner. You know, the New Zealand yen, we could tell that that one is in play. That one is going to be rebalanced. It's lined up to come down. Nice transition. You have a 20 pip range here, another 20 pip range here. So basically they spiked, went high, and now they're down low. They broke the hard stop level here. They're about to break this pivot. Once they break this pivot, they go down to the next level here, which should be another 30 pips. And this trade should come down from this point. If the momentum is increased, it'll come down a good 70 pips. Well, we've identified trades where, you know, in many cases, you know that it's going in that direction, and so you don't fear it anymore. You remove doubt. Why? Because doubt is the one thing that kills you as a trader. That is the one thing that forbids you from pulling the trigger because you don't have all the information. And I really don't care what the candlesticks are doing. For all they could be doing, they could be jumping up and down, but I'm looking at this. I'm like, hey, wait a minute. This thing is telling me a story along with a volume activity, along with a heat map, and so I need to be looking at this and boxing in the pivot and say, hey, wait a minute, this thing's going to come down. The yen is going to get stronger, and the New Zealand is going to get weaker, and they're going to push this thing down. And that's exactly what they're doing. So if you can read your opponent's bluff, then you have a chance. And in this case, we're reading our opponents, and our opponents are very aggressive at deceit. Because it's them against us. It's us against them, and they don't make decisions that are personal. It's business. Pure business. And so, basically, at that point, all we need to do is just identify, hey, what is their hand? Are they bluffing? And if they're bluffing, then I want to know when they're bluffing and where they're going to bluff, because I want them, you know. So I want to know, because I want to make sure that when I take a trade, I feel comfortable with the risk that I'm taking as soon as I place that trade. Because I'm taking on risk every time I execute an order. And so every time that I execute an order, I want to make sure that I don't expose more than 30 pips, because that is my comfort level. That is my risk tolerance. I will not give an additional pip. Now, you'll discover with this that this will make you a 60-40, 70-30 potential trader. What does that mean? Yeah, in some cases you're going to get stopped out. But 60 to 70% of the time, your trades are going to unfold, and they will outperform those trades where you could potentially get stopped out. Why? Because you have to feel comfortable, you know, with your entry. And that's the one thing that we show you. We show you, you know, step by step how to identify these entries, what you should be looking for, how you should read the market, how to read their volume activity, and when to actually look for the entry. Because if it doesn't paint the right picture, like I said, you have no business placing a trade. And that's what this tool does. It acts as a risk management tool to tell you, hey, put your trigger finger away. Put it back. Take it away from the mouse slowly. Yes, it does.
It does
Put,
do that.
put that trigger finger back in its, just slowly walk away from the mouse. Yep, walk away from the mouse. Back away from the screen.
Back away. Listen, I just want to, Ricardo, I hate to cut you off. I just want to wrap it up now. We're going to give it back over to Morgan soon. But you guys come to our training room if you're interested in this technique at all. We've got a couple more August dates left. It's always free. And in September, come September, when the market liquidity picks up again, we'll be rejiggering our schedule a little bit. But we're always going to have these free training rooms. We talk about the entry levels, drilling it down on the shorter time frame charts, and how to exit the trades. We'll talk more about the indicators, what the stops, those two stop barriers that Hawkeye has on the full suite of indicators. And we'd love to talk to you, work with you, help you see if this is the right indicator for you. The Fat Man alone is a very inexpensive, low barrier to entry, I would say, and you can use any of your favorite trading techniques that you use. The Fat Man will make you a better trader because it really will direct you to the right charts to open that particular time, or the trades to stay away from. Because really, if the Fat Man, that Sterling Aussie was a great example earlier, that if the Fat Man tells you not to, you would have needed to be out of this, whatever the heck trade you were showing us earlier, whatever, we want you to be in the right trades and out of the wrong trades. So works on platforms. Yes, we have a Ninja platform. This is an MT4 development we have here. We do have a Ninja platform. We run our MT4 timeframes on the website. There's a futures Ninja development, Hawkeye technology, but we're FX guys, as you can tell. We're training people how to understand the inside baseball world of the FX marketplace. So Ricardo,
yes,
anything you want
you
to
can
say to wrap
also
it?
use this tool, if you really think about it, for currency futures. Why? Because it tells you where their interest lies. So if you're trading the sterling and it's telling you, hey, we're going to strengthen the sterling, well, then maybe you should be looking at the sterling futures. Maybe you should be looking at the Swiss franc in the futures because it's weakening. And the indicator is telling you right here that it's ready to come down because it came down, didn't follow through, came back up, retested, and then they said, nope, it's time to rebalance it. Well, you can use it to trade futures as well. But at the end of the day, it comes down to understanding that there is no madness to the method. It's just rebalancing. It's not manipulation. It's what they do and what they must. They don't have a choice. That choice was taken away when they decided to basically, declare war on the retail trader. And this is the one information that many retail traders don't have and don't understand, and that's why they make mistakes looking at pairs where there is no interest. Because in this case, we've shown you quite a few pairs where their interest lies in rebalancing, and that's exactly what they're doing. That's what they're playing. Well, right now with the volume activity as low as it is, you're going to see that in September, mid-September, when the volatility comes back, because the senior traders are back in the game, in the saddle, you're going to see a lot of these moves that would be 50, right now 50, 70 pip moves will become 100 to 200 pip moves. I mean, we've identified, real-time trades, 300 pip moves during the London session in our room. And a lot of our members have taken those trades, and basically profit from. There's one trade that I want to show you, which is on our website before we wrap it up.
Oh no, Ricardo, we don't have the time for it. I'm afraid we're just gonna have to invite people over to our site. We don't want to take too much of George's time here. You're going to have a real interesting another 90 minutes coming up, guys. So, but we archive our trades on our website. Come visit us, have a look if you like. Come join us in the training room if you like what you see. we're happy to work with you. We think that you're going to like these indicators, and I hope you're going to like our approach to breaking down the institutional markets and what they really are.
Thank you for having us. Thank you, Morgan.
With that, Morgan, thanks for having us, guys. We enjoyed it. We're glad you stayed awake. For those of you starting a new day, good morning. Have a wonderful Friday. Start your weekend early, I imagine some of you.
Thank you very much.
Thank you very much. Morgan, you with us?
Bye-bye now.
Take care, guys.
Hey, Bill and Ricardo, thanks again, guys. Again, like I said, awesome job as usual. And we're now, and you know, the cool thing, they did this with us, like I said, about a month ago, and then this is the second time that we've done the London session with Bill and Ricardo, but they do it on a regular basis. And so again, you can check out their site. Bill can type in the link for you. If you thought that that was interesting and would like to see it more, they'll go even more in depth than they did today for their regular group, and you can learn more from them. So, you know, definitely check it out. And thanks again to the guys over at Hawkeye MT4 for doing that. So yeah, still still sounding good. So we're going into the final leg here. We've got three speakers left. Very excited to have George joining us here. He's going to talk about the bond market, talk a little bit about what he's been looking at in the market